Brendan thought he'd found a home, then the agent asked for more money. Gosh, yeah, we're seeing a lot of this at the moment.
And I think it's pretty demoralizing, particularly when a family's involved, like to be trying to rock up and there's 60 people there. You potentially even need that home more than anyone because you've got to house a family and you don't even get a look in. The agent's also pushing towards a sort of couple. The market dynamics will shift though to a point where they will create more housing some way by actually starting to build. I think this is a misunderstanding. Now people could say trickle down economics doesn't work. I think it does. If you start to build and more things for owner occupiers to move out of houses, then you're going to create more houses for sale, which is then going to be able to create more opportunity for developers to build.
G'day, welcome to the Australian Property Podcast. I'm Pete Wargent from Alan Wargent Property Buyers. I'm here with Chris Bates from the Alcove Group, mortgages specialists. G'day, Chris. How's your week been?
Going well, Pete. It's pretty cracking weather up in Sydney at the moment. Spent the weekend seeing my little niece, 1 week old, so got a proper cuddle this time. It was didn't get a cuddle that much in the hospital. Everyone was a little bit sick, so we had the face masks on, but yeah, that's been keeping me busy. Actually rushing now to the airport as soon as we finish this. We've got a conference down in Melbourne, more of a round table, actually. The 8 biggest practices at AFG sort of have a bit of a discussion around everything it's happening in the market, but also how our businesses are evolving. And so it's going to be an interesting conversation, really. Collectively, it's probably about $10 billion of loans that settle every year. So it's going to be interesting to see what everyone's seeing. It's kind of part of today's chat as well. It's an interesting time. You would think that a lot more upgraders would be in the market, with the anticipation of rate cuts next year and also house prices running on them. But there's real tentativeness we find with a lot of clients that want to upgrade. They just are sitting on their hands, just really fearful that, they don't want to go into a lot more debt too early. So that would be my, and I think we're already really in November, right? So it's going to start to shut down pretty quickly with new listings. We've seen quite a lot come on the last couple of weeks. Not sure if you've seen much in Brisbane, Pete, but it's when people are looking at 2 or 3 good options, you feel like you've got options, and then all of a sudden one sells, and then you're down to one, and then all of a sudden that one, all the buyers flock to that one. So yeah, don't look a gift horse in the mouth. Like we say that lots of times on this podcast. That would be my take at the moment.
Well, yes, I was just looking at the date for the date this goes to air, 26th of October. So we've got a big auction weekend, the weekend this goes live to air, 25th of October. But then we've got Melbourne Cup Day gets in the way. So we'll have 3,200 auctions or so this weekend. But then next weekend is massively disrupted. And then we're sort of deep into November and on the big countdown to the slowdown as we get into the silly season towards December. So there's not many auction weekends left, which is quite scary. This year's gone really quickly. So, and there is, I think if you look at the housing market, Cotality reported the value of residential real estate, 11.8 trillion. Housing values rose 2.2% over the September quarter. So even if there is some sort of nervousness around upgraders and other parts of the market, certainly the first home buyers, the investors are coming in, and it's creating pressure largely because there's just not that much stock for sale. Very, very tight in Perth, Brisbane, Adelaide, even Hobart is tightening up again. So there's not that many listings nationally, and yes, it won't be too long before people are starting to think about Christmas. I actually wasn't in Brisbane the last 3 or 4 days. I've been down on the Gold Coast looking at a few commercial properties actually, and catching up with some friends down on the coast. It's a similar story down there. Not much stock really. A few good commercial options, but the resi market stayed pretty tight. So it seems to be a national trend. I think Cotality said a lot of the suburbs that have recorded the biggest price growth since interest rates started falling have been in Darwin, and conversely Sydney and Melbourne in some cases a bit slower to get off the mark. So obviously different dynamics around the country, but it's certainly very tight in a lot of those other capital cities.
Yeah, it's interesting. I've had a couple of I don't like to cross-promote podcasts when you're on one, but on the Elephant, we had JP, which is sort of one of the best commercial brokers in the country, you'd have to say, up there with probably writing close to $1 billion. I'm not exactly sure how much he writes, but it's a lot. And, he was basically saying that the finance for developers is actually really liquid at the moment. It's one of those things that I even read an article on the weekend that's saying, lending's tight to developers. And he was saying, no, that's just not the case. The problem is that the feasibility of getting these projects to stack up. And I'm really sort of going deep on this at the moment. I'm going to sort of try to figure this out in Melbourne on this trip, hopefully, by talking to friends down there. I've got Nick Riley, Innovate, Ben Kingsley, Empower Wealth, You Financial. There's some really big practices in Melbourne, and seeing what they're seeing on the ground, but also just trying to understand how the government's approaching, releasing more supply. I mean, they've always had greenfield estates in Melbourne. They've always had high density apartments, but are they going to try to unlock the missing middle at the same pace that they're trying to do it in Sydney? I mean, it's every day almost there's a new development sort of getting announced in Sydney. I mean, there's this quite a decent site in Almora Street in Mossman. You've got like a 2-level house, and then next to it you've got an 8-level apartment coming up, and so that's in probably one of the most affluent parts of Sydney. And projects are getting approved that wouldn't, zero chance that an apartment of that size would have been approved a couple of years ago. So it's a real shift that I think people really need to be aware of.
I think, yes, they often say the darkest hours before the dawn, and every shortage is followed by a glut. Actually, if you look at, there was just one stat that caught the eye over the past week or so, and that was the new home sales just suddenly jumped by 26% in the last month. Now, yes, we're coming from a low base. Sydney and Melbourne, new home sales have been chronically slow. And look, a big part of this has been there's just far fewer foreign investors in the market this cycle. But just a few things. Tim Reardon, the chief economist, just said a few things have come together. Rising established prices are pushing more people into the new home sales. And then you've got the waiving of lenders' mortgage insurance, and you've got the prospect of lower interest rates. And just a bit more appetite, I suppose, for risk, and all of those things suddenly coming together. Now, one month is only one statistic, but it could well be that we've sort of hit that turning point for new home sales. And yeah, for sure, it's taking longer than it used to get some of these projects built, but eventually it will happen. I guess you see a lot of sort of doom and gloom articles out there about the housing shortage never being fixed. Well, yes, I think. As you said, almost every day there's another sort of piece of political news, especially in New South Wales, trying to push for more density, easier planning rules, and just the dynamics in the market now. We've got rising prices, falling interest rates, got the government policy on first home buyers. So I think we'll start to see from here that actually home building starts to pick up, even if it does take 2.5, 3 years to see some of these projects get out of the ground properly. So yeah, maybe this is the turning point. What do you reckon?
Yeah, and I think that the government are sort of leveraging that, right? They're saying, hey, quarterly's been the lowest since 2014. We really need to, and Chris Minns is, having a proper attack whenever someone sort of, comes at him for how hard he's going on these policies. He really stands up for all the, yesterday was an article saying the root of all our problems in Sydney comes down to our housing market. That's pretty brave language. So, I do think that we're going to start to see, massive changes to the way that, Sydney's definitely going to shift in terms of supply. I'm not sure about Melbourne yet. Let's figure that one out this week. And you obviously know in Brisbane, I mean, what are they having these same problems in terms of, or zoning and, development appetite not really being such an issue up there. And so if developers do want to build, they sort of can make feasibility stack up.
Oh, definitely for units and apartment towers. In fact, a couple have been sort of pushed through in recent times. South Brisbane, looking at micro apartments and things like that. But I think for Brisbane and Gold Coast, it's very much a cycle. There's so many places you could build more density, but the appetite for it over the last, really since the peak of the last cycle, has been very low. I think a lot of people got burned. There's a bit of an oversupply 10 years ago. Now we've shifted into the undersupply phase. But yes, I think in a city like Brisbane, there's far fewer apartments anyway. If you look at it as a share of the housing stock, and there's stacks of places you could build more apartments, Hamilton, North Shore, but even close to the city. So yeah, if you look at the approvals for Brisbane, they are starting to pick up, but it's there's sort of no boom yet or anything like that. So yeah, I think it'll come around. I think on the interest rate point, we'll have to wait and see. I think we'll cover today the unemployment rates figures jumping. Well, it looks like the Melbourne Cup Day RBA meeting, as it often is, seems it could well be a live meeting. A lot depends on what happens to the inflation figures, but with unemployment now rising, there's a bit of a conundrum there for the RBA as to whether they cut interest rates. I think from the economy point of view, of course, we know that residential construction has a very strong multiplier effect across the economy. It's a big employer, and there's a lot of there's a big sort of multiplier. You know, every dollar you spend on resi construction sort of reverberates and sort of causes $3 of spending across the economy. So I think if we get the housing construction boom moving, it'll be good for the economy over the next 5-10 years. But it's been a bit of a slow start so far, and I guess that the sort of outcome of that has been a lot of pressure at that lower end of the market. Investors competing with first home buyers for the sort of the cheaper prices in the capital cities or the cheaper properties. So I think that's really what's creating the pressure at the moment. Is a lot of investors coming back in, first home buyers desperate to use the 5% deposit, and now even maybe a bit of FOMO for buying off the plan as well.
Yeah, and I just wonder, Pete, and there's an article today, right, about average time from approval to completion on sort of new builds. So approval to completion, I mean, it doesn't mean that once it's approved, you have to build, but, you know, it was a pretty steady for sort of townhouses, which is obviously a lot of investors are playing in there, so they want to get it done quick. You know, a lot of houses, like it's often people are only lodging when they actually want to get it built. So, you know, houses were pretty quick, you know, it was around sort of, 9 months, but it ballooned to like 14 months over the last, few years. And townhouses have gone from, say, 12 months to sort of 17 months. And apartments are the biggest one. A lot of approvals happened, in the sort of, 2017 to 2020 period. But the time to actually build them has basically gone from, 1.5 years to almost 3 years. And so there's been this real desire to not get started on builds, or they're taking a lot longer to actually get built. So, that's an interesting play, right? Because not only approvals getting slower, but they're also, once they are getting approved, they're taking a lot longer to actually hit the sort of the market. What's your thought on that, Pete?
Though, the quality is different. I think in the previous cycle, yes, I mean, I think we all saw examples of poor quality housing stock being sold to foreign investors, and a lot of defects sort of then came back to bite later on. I mean, actually, I was always amazed, actually, in the previous cycle, how quickly a house could go up. I think if you go to over to Europe, sometimes it's very frustrating seeing how long it takes all these projects to come together. It takes years to get a house built. And yet in Brisbane, around the train stations, house gets approved, house gets built, like 6 months, and there's a new house. But it definitely has slowed down in this cycle. And I think for the apartments, I think just generally speaking, what we're building is bigger and better and more directed at home buyers. Yeah, whereas I think in the previous cycle, it was kind of build anything and flog it overseas. And of course, there were some major defects in some of those apartment towers, and hopefully the regulation's a bit tighter this time around. So hopefully fewer issues. So now I know you're on a rush to get to Melbourne this week, Chris. So let's crack on with the big three property news stories of the week. So this is our weekly 2 cent segment where we go through the big three news stories, and then stick around. We'll have time for a Q&A at the end, listener Q&A, so do send in your questions for those as well. So first story this week on the economy, the unemployment rate spiked to a 4-year high of 4.5%. So the median market forecast was for a slight sort of uptick to 4.3%. In fact, the previous month got revised up to 4.3%, and the unemployment rate was 4.46, the 2 decimal places. So that rounds up to 4.5%, which suddenly looks like a whole different cycle. I guess it had seemed like, unlike New Zealand and Canada and the UK, that Australia had found a way to keep the unemployment rate very low, and suddenly it doesn't look quite so much the case. I think we've got big population growth, very high or record high participation rates across the labour force in the economy. And it suddenly looks like jobs growth has stalled a bit. We had been very dependent on government jobs, and particularly healthcare and social assistance jobs. And suddenly the jobs growth seems to have just run out of steam over the past few months. So the unemployment rate suddenly jumping higher than anyone had forecast this month to 4.5%, highest since 2021. So, yeah, I guess in a normal course of events, the RBA would be looking to cut interest rates November and December, and market pricing at the time of speaking anyway is about 70% for a rate cut. But we'll have to see what the inflation figures bring next week. I think that's the one point of concern for the central bank is we saw that rents have re-accelerated over the past few months. We've got a bit of a base effect thing going on, so the inflation rate over the past year looks a bit higher than he's comfortable, possibly pushing towards the top of the band again. So, yeah, I mean, I don't know whether rates will go down in November or not. That will depend on inflation. But what's the implication for lending, Chris? The borrowers, when they come to you, or prospective borrowers, do they sort of talk about the outlook for interest rates, or are they more focused on the property deal? Does it have an impact on sentiment?
Oh, I think it depends on the type of buyer. So, first home buyers often, they're sort of getting ready, and when they're ready to go, they're not too concerned really where rates are going to go over the next 3 months. They're sort of, the FOMO of buying is probably bigger. Investors, yeah, I mean, whether they get 1 or 2 rate cuts, they're like, oh, is it a priority in their life or not? And they're often acting out of sort of fear and trying to play catch up. And so they're not saying, oh, maybe I should wait, because they always have the fear as if they waited for that rate cut. I do think upgraders are massively impacted on the rate trajectory. You saw when rates went low and went lower, and when it surprised people and they were expected to stay low, what absolutely happened was that owner-occupier boom. That was what drove that 2020, 2021 boom, to new levels. And I think that's what will drive, particularly the upper end of the market where people upgrade, is when, there's confidence that rates are likely to keep on going lower, not staying higher. Yeah, I mean, obviously that unemployment rate's an interesting one, Pete. I think, when people talk about the property market, they always talk about, oh, it's multiple of incomes, 11 times, and but there's reasons why property market's gone up a lot over the last, say, 3 or 4 decades, right? Not to say that those reasons can then continue, but I mean, back in sort of the 80s, I mean, the female participation rate was around sort of 45%, and men was probably close to 80%. But if you look over the last sort of 40 years, the men participation rate's actually dropped to sort of 70%, and the female participation rate's gone 40 all the way to 62. So, what do you think about that, Pete? Do you think that, those trends are going to continue? Either the male participation rate's going to keep dropping, or the female's going to keep increasing? Or do you think that they're both potentially going to reaccelerate? What's your sort of take on that? Because that participation rate has a huge impact on the unemployment rate, right? Like, it's the more people looking for jobs, really. And so the more jobs that we need for them. I mean, how do you think that's going to play into things?
It's been a massive ongoing trend, really, for 45 years. I mean, if I just think back to sort of my childhood, we had, when I was from a big Catholic family, and my mum did sort of work periodically when money was short and interest rates were high. My mum went off to do some supply teaching or something like that. But basically, it was a husband working to provide for 7 people. And that dynamic is much rarer these days. I think if you look at a share, I mean, it was kind of like, half the market was husband working and wife not in the labour force. So Cameron Murray actually just rehashed these figures. Dr. Cameron Murray is an independent economist this week, and he just said, if you look at the ABS figures, if you went back to 1980, there was actually fewer families where you had 2-parent families both working. That was less common than just having a husband working and the wife not in the labour force. Well, that figure has just gone up and up and up for basically the last 45 years, and now it's at a record high. It's about 70% plus and rising. So that's, I mean, when you think about housing affordability, I mean, it doesn't help you much if you're a young single person, but yes, I mean, one of the things that Cameron often points out on his podcast when he appears on shows and so on is that if you look at the proportion of income that goes on rents, it never changes. It's just been around 20-25%. And the amount that people spend on housing as a share of their income on their mortgage, it doesn't really change. It goes up and down through the cycle, but there's just a lot more 2-income families now. And it, to date anyway, just hasn't slowed down. We've got participation rates at all-time highs. So, yeah, I mean, I suppose the conspiracy theorist, I remember once I went on Channel 7's breakfast show and I was chatting to Dr. Carl in the green room, and he was saying, well, hang on, how come my dad, you could just work and pay for a house and a mortgage, and now it needs two incomes? Well, yeah, that's what has happened over the last 45 years, is that we've got higher incomes, but people directed back into land and housing. So, and the conspiracy theorists would say it's by design. Other people would just say that's how the market economy has worked. But it hasn't slowed down anyway.
Yeah, absolutely. I mean, it's going to be interesting to see how this sort of plays out with interest rates. I don't think they're going to cut personally. I would just bet that they're going to try to keep the firepower, because it's always an interesting time, November and December and January. Sentiment can change a lot because the property market's sort of basically shut down, and then it can either really increase, confidence can change. I remember back, it was 2020, I think, to 2021. I think it was that year. It might have been a different year, but basically between November and February, the market absolutely shifted 10, 15%, and everyone got shocked how much it rose over that Christmas period. And his confidence just built and built and built. And all of a sudden, a lot of buyers came back with news. So, putting a rate cut now is only going to potentially add a lot more buyers at a time when not much supply is going to come on, and it's going to give the market a real kick in February. And I don't think the government really wants that. I know they're not trying to target house prices, but they don't also want it start to run on them, which, even though it's only one rate cut, it's just the confidence that it sort of provides. I don't think it's in their interest. What do you think, Pete?
That sort of ties into the second news story. So I want to circle back to your point on interest rates there, Chris, because I know you've got a related point to make on tighter lending standards from APRA. So the second story we already touched on. Policy changes sees a spike in home building. So new home sales rose 26% last month. So yes, we've got the 5% deposit scheme, but we've also got lower rates, more confidence for developers because prices are rising. And it's, I think, yes, one data point, but it's the first sign that housing supply is set to pick up. And I think just coming back to the point on interest rates, and there's a lot of signs like this that, yes, okay, jobs growth is stalled, but maybe lower interest rates are starting to have an impact. And yeah, okay, we've got rising unemployment, but it's still only 4.5%. It's not like we've got very high unemployment rates, not panic stations just yet. So yeah, I mean, look, it depends on inflation, but I wouldn't be at all surprised if the RBA is keen just to sit pat and just see what happens over the next few months, because if home building is starting to pick up, investors are piling into the market, first home buyers are piling in. Do we really need another interest rate cut into that environment? And I suspect there'll be a bit of reluctance. Chris, on a related point, I saw you wrote this week about APRA's potential to step in and discourage investor lending or interest-only lending if it gets too hot, which is pretty interesting because I did see in the latest totality figures, high debt-to-income lending is near enough record lows. High loan-to-income lending ratios are also near record lows. Their lending standards haven't really loosened a lot, but even still, the market regulator is making noises that if there's an investor boom and a first-home buyer boom, then actually we could even see lending standards tighten further if required. So I know you're closer to this than me in the lending world. So what do you think?
Oh, I've just been sort of trying to look at how, because I've been quite vocal on the dangers of, basically the last few years of a lot of investors heading to the same hotspot and basically shifting what was a typical owner-occupier driven market to an investor market and pushing it past what locals can afford. I mean, I've sort of seen that play out. It's almost like, and I do think once the tide goes out, you'll find that people have been caught out here. And unfortunately, a lot of the people driving that are, when you start as a buyer's agent, you really want to get clients. Owner-occupiers are quite hard to win as clients, I would say, but investors are much easier. And you can sort of go around and rattle the tin and speak to your mates and be borderless investing. I think a lot of the new buyer's agent have been investor specialists, often buying in locations they've never lived or in before. And you've also seen there's a little bit of a cult between these two tiers of buyer's agents. So you've got all these new cats on the scene, which everyone starts somewhere. So it's nothing to do with that. It's more that when they're also a lot of proliferation of buyer's agents have entered the industry, a lot with social media, and they're all marketing because they haven't got any clients. And this is creating a lot. And then also a typical great market momentum, right? The compressed borrowing capacities, people not wanting to upgrade their home, higher interest rates, pushing people to want to spend less. and have higher yields. And then all of a sudden there's these, I might buy an investment property and this, I'll get rich quick type of marketing is everywhere. And it's almost like this self-fulfilling prophecy. I bought that for the client for 400, now it's worth 480. I'm, Nostradamus here. I know where the market's going to go up. Engage me. And the problem with that is you are creating mini bubbles or mini sort of parts of the market that have gone past what the locals can afford, and they're not sustainable. If you see a point where the investors bail because it is a momentum strategy, it's not a long-term buy and hold. So what APRA cares about, and also ASICs and banks, is stability in the system. This type of investing isn't stable. It's sort of like a more share-based sort of speculation type in the property market. And I don't think anyone wants that, right? So I think that's what we're seeing. You saw Michelle Bullock sort of mention this last week at a conference. The banks have talked about it. So I think everyone's aware of it. And if you add on top of that, the marketing that we've been seeing around sort of unlimited borrowing capacity in trusts, people who aren't licensed to give that advice, and that's really gone. Like, that's some of the most popular content. We could do it here on the podcast, right? And we could go and get a lot more views if we just sort of perpetuate this lie. And it's sort of almost dangerous lending. We've seen some changes here as well. And so I think we're going to see a real shutdown of that. I think the banks are going to get told off. I think the brokers that are writing those type of loans are going to get told off. And I think the accountants that are also perpetuating this strategy, and I think self-managed super funds going to come back into the regulator's eyes, because I think people are leveraging their super, and a lot of non-banks are playing in this space. I just think it's sort of but just because I think the murmurs, often you see the murmurs in the media first. The second thing is, I actually interviewed Ben Kingsley on The Elephant last week, and I read his article a few months ago about this as well. He was probably ahead of me. I think it was one of those things that I read and I sort of thought, yeah, that makes a lot of sense. And then I was almost like building my own sort of view on things as well. And it just really cemented it. He's seeing exactly what we're seeing. And he wrote a submission, and he highlighted a lot of really good points around what we're seeing both lending and buyer's agency. So let's say, that makes sense, right? Because also if you look at the quartality numbers as well, every month I look at it, I go through that report and I just think, hang on a sec, this investor lending is really starting to dominate the market. And while we need more investors in the market, we've got a rental crisis. It's not typically going where a lot of investors are selling. And so is this great investing? Are we buying in the capital city? Often we're buying in more regional areas where we're going to get a glut of rental apartments or rental properties and an undersupply in other markets. And people would just say that's market dynamics, but no, it's not. It's because of this shift in the way that investors are behaving.
Well, yes, I was actually, when I was down on the Gold Coast this week, it's a bit self-selecting. My friendship group is often itinerants who've lived here, there and everywhere, Sydney, Darwin, wherever. And, just the word around the traps is a lot of our friends are leaving Darwin. Some of the issues have been around safety concerns, bringing up families, but a massive part of it is that it was affordable, and now we're going through another property boom. I saw the same thing in 2011 when everyone was talking about, bloody hell, look at the price of housing, and then it did absolutely nothing for maybe 12 years, and now we're into the boom phase of the cycle. But it's not being driven by locals. It's being driven by investors from Sydney, Melbourne, and wherever else. So, that's a concern, because it's not being driven so much by market fundamentals. There's no population growth in the NT. It's just people piling in, a bit of a pyramid scheme, I suppose, which is great if you get in early, but you wouldn't want to be the last person buying and holding the bag. So let's look at the third story of the week. This is an article from Domain. Negotiation tips. Headline: Brendan thought he'd found a home, then the agent asked for more money. Gosh, we're seeing a lot of this at the moment. It's frustrating, even as a market professional. You do all the due diligence, and then someone comes along and offers more money. But the same is true in the rental market as it is for home buyers at the moment. There's shortages of affordable homes for key workers that you mentioned last week. And from this article, I quote, in Melbourne's West, Brendan was looking for a rental property advertised for $420, and the agent said, if you give us $490 a week and 3 months rent up front, the house is yours and you can jump the queue. Yeah, so we're quite familiar with gazumping and when you're buying a home, especially if it's a sought after home in a sought after suburb. But it doesn't usually happen in the rental market, and that's quite disheartening, I think, especially as you said, Chris, because a lot of people like teachers or so on, they have to be in certain areas to do their work, and if they find a rental property and then find they're being outbid even for a rental, it's a tough environment. What sort of tips can we give to people who are facing that situation? I mean, the market is the market, and it's difficult when there's a lot of people looking. I suppose as a buyer's agent, what we try to do is we get very clear on what we're looking for, and then we build the relationships with the local agents. So when the right thing comes along, we can move really quickly and very decisively. And I suppose the same would be true in the rental market as well, is that you need to really be sort of first up, best dressed, because in certain parts of the market, there's heaps of competition. Yes, we see all the TikTok videos in Bondi and Bronte, but those are really popular suburbs. But it seems even in suburban Melbourne and Sydney, this is proving to be the case as well, and it certainly is in Brisbane.
Oh, look, I think this highlights why targeting investors of the problem is a bit naive, because if we're having not only a housing affordability crisis, and then you can't even afford to rent, and you're getting, it's okay if you've got 2 jobs, you haven't got a dog, you haven't got any kids, and you've got a good history, and you've got, you're renting well within your means. You put your application together, and maybe you've got a couple of references, and you put it in front of the real estate agent's nose. Very quickly, you're probably going to be okay to get a rental property. But as soon as you start adding, maybe one's not working, maybe a baby, maybe it's an animal, whether it's maybe you just moved back from overseas, or maybe you moved out of home, or, you didn't have a great experience with your old tenant, your sort of old property manager, because your landlord wasn't looking after the property, and you just expected, and you had reasonable expectations, and they thought you were being, a pain in the ass. Like, I think that you can very quickly have issues getting rental, and you rock up, and I think it's pretty demoralizing, particularly when a family's involved, like to be trying to rock up and there's 60 people there, and you just, you potentially even need that home more than anyone, because you've got to house a family and you don't even get a look into, you get sort of discriminated against, because the agent's also pushing towards a sort of couple. And so I do think these are the real issues that, the city's facing, and hence why we do need to build. And a lot of people say, oh, well, it's not going to build for that right now. Well, yeah, the market dynamics will shift, though, to a point where, they will create more housing some way by actually starting to build. I think this is a misunderstanding. Now, people could say trickle-down economics doesn't work. I think it does. I think it's, if you start to build more things for owner-occupiers to move out of houses, then you're going to create more houses for sale, which is then going to be able to create more opportunity for developers to build. And so you've got to create movement. And at the moment, you can only create movement at the top. And so, I think this is why it's so important. This cuts to the real issue. It's not so much being able to afford to buy, it's also being able to afford to rent. And not just people from Sydney, people moving here from overseas. And a lot of people are blaming international students and Airbnb. But the real issue is that we're not having got enough investors basically investing back into our capital cities and creating enough stock for rentals. And also a lot of people just target investors as the problem. That's the reason why house prices have gone up. It's not really the case. It's often driven by owner-occupiers, not so much investors, these markets.
The local agent in Melbourne's north and west said there isn't a huge supply of asking rent of $400 to $500 a week. He's noticed more, quote, multi-family applications such as 3 generations or 2 married couples even. Often renters are stretching themselves to the absolute max in order to be able to qualify for a rental property. Yeah, I think to your point, I think sometimes we get confused here about how rental markets can be tackled. And people say we need to build more affordable housing. I disagree. That actually gets in the way of sometimes these developments. If you mandate that a developer has to include 25% affordable housing, it sounds good on paper, but it just means fewer developments. What we really need is, let some of these micro apartment towers get built. Let developers build more, because eventually it solves the housing shortage. I think if you mandate that you have to build a certain number of affordable homes, or you have to provide them at a certain rental level, yeah, I mean, it sounds good, but it just doesn't work in the same way. If you just build more housing, that's how rents eventually level off and come down. So, and that's a lot of what's being debated in New South Wales at the moment. And Chris Minns is at the forefront. So, yeah, I think it's volume and quantity has a quality all of its own, as Stalin once said. So we've just got time for maybe a listener question before you shoot off to catch your flight, Chris. So from related actually on super funds, self-managed super fund investing from Specky McGee. I'm thinking to use my super to buy an off-the-plan unit. Obviously, taking note of some of the things we've said before about the risk of buying off the plan. With ocean views, it doesn't settle for a few years, and it's only a small amount of my balance brackets. Well, the deposit is. Most of my wealth is outside super. Is this a bad idea or worth pursuing? Yeah, so I think just coming back to Chris's point before, some of the things that get caught in the crosshairs when there's a crackdown on lending can be self-managed super fund lending, investor lending, and if you put down let's say a 10% deposit, there's a possibility that the lending landscape between now and whenever this property gets built is completely different. Today, you might need a 20% deposit or 25 or something, but then it might be a completely different environment in 2 or 3 years. So I suppose that quite apart from the risk of the property not fulfilling your brief and not looking like the brochure, that's, I suppose, the change in the lending standards could be the big risk. What do you think, Chris?
Oh, look, super and off the plan apartments, I think it's too risky. You've only got one chance with your super fund. I think you've got to be extremely, often a lot of people are very heavy on resi in their personal life. Do you then want to get heavy in your super fund on resi? So whenever clients come to us for self-managed super fund lending and residential property, we're always like, and even though lending has changed heaps in the last couple of years, it's way more options than they were 2 years ago in terms of the amount you can borrow. We're always like, yeah, take risk personally. If you make a bad decision and you've already got a number of other good assets, then yeah, that maybe won't, completely ruin, your financial situation, and maybe you can unwind it and it's easier and it's more cost efficient, but you don't want to punt your super fund. You want to just know that that's your backstop, right? And you're putting in your 12% a year right now. That's going to end up being a lot of money, particularly if you're sort of in your 30s, 40s and you go and work for another 10, 20, 30 years. You really, if you're going to buy something in there, buy something that is going to perform well over the long term, because you don't really want to trade property in there. You don't want to kind of, but if you can buy a good asset and you can hold it for 30 years and you can just sleep at night going, I don't really care what happens in the world over the next 5, 10 years. I know in 30 years when I want to sell that property, it's going to do really well for me because it's super scarce, high quality land that's going to be really desirable in the world that, is in 20, 30 years time. That's what you want to buy in your super fund. I wouldn't be going anywhere near off the plan.
Yeah, I think by the tenor of the question, I think maybe the person asking actually sort of knew some of that. Even the name Specky McGee sort of gives it away a little bit. But what's on for you this week, Chris? I'm just going down to Ipswich for the AFLW this weekend, and we've had a busy few weeks at the Gold Coast doing all the parks as well. So I think just chilling out for me. What about yourself?
Yeah, chilling out. My dad's in town from Melbourne. It's a bit of a sliding ship, so I'm going down there when he's coming back here. But going to spend more time with my little niece, to be honest, and also got a little bit of a birthday party for my wife on Sunday, so that should be fun down at Clareville Beach. So that's me. It's a lot of family time.
Terrific. So send in your questions and we'll cover those in next week's 2 cents. We've also got our deep dive on immigration and local demographic trends for you to catch up on during the week. Also come and join us at the Rask Community Forum. That's community.rask.com.au. Lots of good chat and free resource over there. So thanks, Chris. Always enjoy the chats and look forward to catching up next week.
Talk next week. Thanks, Pete.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel, or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.